You can pay $1 million for a home, call yourself the owner, sell it, mortgage it, and leave it to your children, and still watch the legal life of the property shrink every year. Singapore sells many homes on 99-year leases, and London is filled with leasehold flats. Hong Kong's land system also runs on government leases. But a home with 95 years left is not the same asset as one with 35. So what exactly are you buying when ownership comes with an expiration date? To answer that, we have to clear up a common misunderstanding. A 99-year lease is not a long rental contract in the everyday sense. The buyer acquires genuine, transferable ownership for the duration of the term. You can live in the home for decades, renovate the kitchen, take out a loan against the equity, and eventually pass it down to your heirs. The asset functions almost exactly like permanent property, but the legal object being purchased has a boundary. You own the right to the property strictly for the remaining lease. That legal reality creates a mathematical countdown. When a lease is freshly minted, the difference between perpetual ownership and a 99-year limit feels completely invisible. A 20-year-old buyer won't live to see the end of it. But as the clock ticks down past year 40, year 60, and year 80, the exact same physical home becomes a completely different economic asset. Singapore provides the clearest example of how this time limit works by design. The vast majority of new public housing flats here, built by the Housing and Development Board, are sold on 99-year leases. This structure isn't an accident of history. On a small island with extremely limited geography, permanently selling every residential site would eventually lock away all valuable land rights. The 99-year lease gives an individual household long-term stability, while ensuring the land eventually returns to the state so it can be redeveloped for future generations. This chart shows the relationship between a property's remaining lease and the size of its eligible buyer pool in a system like this. Notice the flat with 95 years left. It has massive market appeal. The 65-year flat still attracts a broad range of buyers. But look at the steep drop when the property reaches 35 years remaining. The pool of willing, able buyers narrows sharply. That narrowed pool does not automatically render the short lease property worthless, and shorter leases produce lower purchase prices. If you are a 70-year-old buyer looking for an affordable place to live out retirement, a heavily discounted 35-year lease might provide exactly the occupancy horizon you need. Why pay a massive premium for 60 extra years you don't expect to use? Property value in a leasehold system relies entirely on matching the duration of the asset with the exact time horizon of the household buying it. We can see what happens when the legal countdown starts to interfere with financial viability by looking at England's market for leasehold flats. Many of these concrete structures were built to last, but the paperwork controlling them is slowly evaporating. A 30-year-old buyer might purchase a flat with 50 years left and think they have plenty of time. The issue is the next buyer problem. If they decide to sell that flat 20 years later, the next person in line is buying an asset with only 30 years left. Current value is dictated heavily by the financial reality of whoever has to buy it next. This animated timeline shows how a lender calculates that risk. Banks do not simply ask what a property is worth today. They ask what their security will look like decades from now. Look at what happens if a bank issues a standard 30-year mortgage on a property with 45 years remaining. By the time the loan matures, the collateral has only 15 years of legal life left. That makes the property highly illiquid, which is why lenders often impose strict minimum remaining lease requirements. In places with established extension rules, a buyer can sometimes pay a fee to legally extend a lease. The walls don't move, the neighborhood doesn't change, the physical apartment remains entirely identical. The owner is simply buying time. Time itself is a commodity with a discounted market value. When a lease gets too short, banks refuse to finance it. Without mortgage access, the buyer pool shrinks to cash-only investors. And when the buyer pool shrinks, the resale price falls. When an entire city runs on time-limited land, you eventually face the systemic threat of thousands of properties approaching zero simultaneously. Hong Kong is perhaps the most extreme example of this density, with a market almost entirely dominated by government land leases. You will frequently see the claim online that all property in Hong Kong simply expires in 2047. That is a massive oversimplification. You cannot just subtract the years to 2047, draw a hard line, and assume the asset evaporates. To prevent market panic, Hong Kong introduced a new statutory mechanism in 2024. The government can now publish notices extending batches of qualifying leases well before they expire. It takes an approaching cliff edge and turns it into a manageable administrative process. Leasehold prices do not rely solely on the raw number written on a contract. They rely heavily on policy certainty. A 40-year lease in a city with a clear, predictable extension framework is worth substantially more than the exact same lease in a city without one. We can contrast these expiring markets with Dubai. In designated areas here, foreign buyers can acquire freehold property. Freehold is an indefinite legal interest. There is no 99-year countdown attached to the land rights. The owner's interest continues perpetually, subject only to local laws and taxation. But buying a freehold condominium does not mean you achieve total financial independence. You do not own a physically marked rectangle of earth beneath the tower. You own a unit and a shared interest in the common property. You still face service charges, collective maintenance decisions, and the reality of aging infrastructure. Freehold tenure removes the anxiety of a legal expiration date. It guarantees the land belongs to you indefinitely. It does not stop the physical building from falling apart. Japan perfectly illustrates this distinction. In the Japanese system, private freehold land ownership is very common. You can own the dirt forever. Yet the houses sitting on top of that permanent land depreciate heavily over time. The physical structure loses market value as it ages, even as the underlying permanent land retains its worth. This diagram shows what we can call the two clocks of real estate. On the left is the physical clock tracking the deterioration of the roof, the plumbing, and the facade. On the right is the legal clock tracking the countdown of the title. In a leasehold market, both clocks are ticking at the exact same time. This creates a renovation paradox. If you spend $150,000 installing a luxury kitchen in an apartment with 20 years remaining, you reset the physical clock. You make the space beautiful, but you add absolutely zero time to the legal clock, severely limiting your ability to recover that investment when you sell. It also changes the nature of generational wealth. If you buy a 99-year lease at age 30 and pass away 40 years later, your child does not inherit a fresh 99 years. They inherit 59 years. The wealth transfers, but the quantity of time transfers shrinks. When you walk through a property, the walls tell you how much space you own. The title tells you how much time you own. And in a leasehold market, time eventually becomes the most expensive part of the transaction.